Here is a situation I want you to think about carefully because it is happening to retired Americans every single year, and almost none of them see it coming before it is too late. You are retired. You have a brokerage account, a taxable investment account with stocks or mutual funds that you have been holding for years, maybe decades. The market has been good to you. Those positions have grown significantly, and at some point in retirement, you need to sell some of those holdings. Maybe you need the cash to cover living expenses. Maybe you are rebalancing your portfolio. Maybe you are selling because a financial advisor told you it was a smart move to lock in gains. Maybe you are just simplifying your financial life and consolidating accounts. The reasons are completely reasonable. The decision seems straightforward. You sell. You get the money. You move on. And then the following year, your Medicare premium statement arrives, and the number on that statement is dramatically higher than what you were paying before. Not a little higher. Dramatically higher. Hundreds of dollars per month higher. And you have no idea why, because nobody connected those two things for you. Nobody told you that selling stocks in a taxable account in retirement could trigger a Medicare surcharge that lasts not just for 1 year, but potentially for multiple years, depending on your situation. Nobody explained that the capital gains from that sale would count toward an income threshold that determines what you pay for your health coverage. And by the time you understand what happened, the sale is done, the tax year is closed, and you are stuck paying the higher premium. This is the capital gains IRMAA trap, and it is one of the most overlooked and most costly mistakes that financially comfortable retirees make. Today, we are going to break it down completely so that you understand exactly how it works, who it hits hardest, and what you can do to protect yourself from walking into it. I'm Jason, and this is Jason Retires. This channel is built around one simple mission, giving everyday Americans the honest, detailed, practical information they need to navigate retirement without getting blindsided by the rules that nobody bothered to explain. If that sounds like something you want in your corner every single week, subscribe right now and hit that notification bell. Every video we publish is designed to be genuinely useful, not just interesting, actually useful for making better financial decisions in retirement. Now let us dig into this topic because there is a lot of important ground to cover and every piece of it connects. To understand the capital gains IRMAA trap, we need to start with a clear understanding of two separate concepts and then show you exactly how they collide in retirement. The first concept is capital gains taxes. The second is IRMAA. Most people have at least a surface-level understanding of both individually, but the interaction between them in a retirement context is where the real danger lives, and that interaction is what most people have never had explained to them clearly. Let us start with capital gains. When you own an investment, whether it is a stock, a mutual fund, an exchange-traded fund, or another asset held in a taxable brokerage account, and the value of that investment increases over time, the increase in value is called a capital gain. You do not owe taxes on that gain while you are still holding the investment. The gain is unrealized. But the moment you sell the investment, the gain becomes realized, and it becomes taxable income for that calendar year. The tax rate you pay on that gain depends on how long you held the investment. If you held it for more than 1 year, it is a long-term capital gain, and it is taxed at preferential rates of 0, 15, or 20%, depending on your total taxable income. If you held it for 1 year or less, it is a short-term capital gain, and it is taxed at your ordinary income tax rate, which can be significantly higher. For most retirees selling investments they have held for many years, the gains will be long-term and taxed at the preferential rates. And here is where people make a false assumption that gets them into trouble. They think that because long-term capital gains are taxed at a lower rate, they are somehow less impactful on their overall financial picture. They think that 0% or 15% capital gains taxes are manageable and not worth worrying too much about. And from a pure income tax perspective, they might be right. But capital gains do not just affect your income tax bill. They affect your modified adjusted gross income, which is the number that determines your Medicare IRMAA surcharges. And on the IRMAA side, a dollar of capital gains is treated exactly the same as a dollar of any other income. There is no preferential rate. There is no lower threshold for investment income. If your capital gains push your modified adjusted gross income over an IRMAA threshold, you pay the full IRMAA surcharge, period. Now let us talk about IRMAA in the specific context of capital gains, because the mechanics here are critical. IRMAA, which stands for Income-Related Monthly Adjustment Amount, is the surcharge added to Medicare Part B and Part D premiums for beneficiaries whose income exceeds certain thresholds. For 2024, the standard Part B premium is $174.70 per month. For a single filer, the first IRMAA surcharge kicks in at $85,000 of modified adjusted gross income. For married couples filing jointly, the threshold is $170,000. Once you cross those thresholds, the premium jumps significantly, and it continues to jump at higher income levels. Here are the specific Part B premium amounts for 2024 based on income tiers for single filers. From $0 to $85,000, the standard premium of $174.70 applies. From $85,001 to $107,000, the premium jumps to $245.90. From $107,001 to $160,000, it rises to $350.90. From $160,001 to $500,000, it climbs to $499.85. And above $500,000, the premium reaches $594 per month. For married couples, those thresholds are approximately doubled at each tier. Now add Part D, IRMAA surcharges on top of the Part B amounts, because both apply simultaneously if your income is above the threshold. The Part D surcharge ranges from $12.90 per month at the first tier to $81 per month at the highest tier, added on top of whatever your specific Part D plan premium already is. When you add together the Part B and Part D IRMAA surcharges, a single retiree who crosses into the second tier of IRMAA is paying roughly $221 more per month than a retiree just below the threshold. For a married couple where both spouses are on Medicare, that surcharge doubles. That is $442 per month in additional Medicare premiums for the couple, which is $5,304 per year in excess costs, all because their income crossed a threshold. And here is the most important detail about how IRMAA works that connects everything together. Medicare uses your income from 2 years prior to set your current year premiums. This is called the 2-year look-back. Your 2026 Medicare premiums will be based on your 2024 income. Your 2025 Medicare premiums were based on your 2023 income. This 2-year delay is what makes the capital gains trap so particularly insidious. You sell stocks in 2024. You receive cash. You spend it or reinvest it. Life moves on. And then in 2026, your Medicare premium is suddenly much higher than you expected. The connection between the 2024 sale and the 2026 premium increase feels distant and confusing because 2 years have passed. Many retirees genuinely do not make the connection on their own. They call Medicare, they call Social Security. They are confused, they feel like a mistake has been made. And then someone explains the 2-year look back, and the whole painful picture becomes clear. Let us put real numbers on this with a concrete example so you can see exactly how the math works. Meet Robert and Patricia. They are both 68 years old, both on Medicare, both collecting Social Security. Robert gets $2,100 per month from Social Security, and Patricia gets $1,500 per month. Together, that is $43,200 per year in Social Security income. For IRMAA purposes, 100% of their Social Security counts toward modified adjusted gross income, so they start with $43,200. They also have a traditional IRA from which they take required minimum distributions of $32,000 per year. That adds another $32,000 to their modified adjusted gross income, bringing the total to $75,200. As a married couple filing jointly, this puts them comfortably below the $170,000 IRMAA threshold. They are paying standard Medicare premiums. Everything is fine. Now Robert decides it is a good time to rebalance their taxable brokerage account. They have held a diversified stock portfolio for over 20 years, and several positions have appreciated significantly. They sell $120,000 worth of stock. Their original cost basis in those shares was $30,000, so they have realized a long-term capital gain of $90,000. That $90,000 gain is added to their modified adjusted gross income. $75,200 plus $90,000 equals $165,200. They have now crossed the $170,000 threshold for married couples filing jointly. Actually, in this case, they are just under. But if their Social Security was slightly higher, or their RMDs were slightly larger, they would cross it easily. Let us say their Social Security is a bit higher, and their total modified adjusted gross income lands at $180,000 after the capital gain. They have now crossed the first IRMAA A tier for married couples. For 2026, both Robert and Patricia will pay $245.90 per month for Part B instead of $174.70. That is an increase of $71.20 per person per month. For both of them combined, that is $142.40 per month in additional Part B premiums. Add the Part D IRMAA surcharges for both of them, and the total additional Medicare cost for the couple in 2026 is approximately $2,000 for the year, purely because of that one stock sale in 2024. And if their gains had been larger, pushing them into the second or third IRMAA tier, the additional cost would have been dramatically higher. Now here is the part that makes this especially frustrating from a planning perspective. The IRMAA thresholds are structured as cliff thresholds, not gradual phase-outs. That means if your income is $1 above the threshold, you pay the full surcharge for that tier. There is no partial surcharge for being slightly over the line. If you are a single filer with $85,000 in modified adjusted gross income, you pay the standard premium. If you have $85,001, you pay the first tier IRMAA surcharge. The jump from the standard premium to the first-tier premium is more than $70 per month per person. $1 of extra income triggers a more than $800 annual increase in Medicare premiums. That is not a rounding error. That is a cliff, and falling off it because of a stock sale you did not fully think through is entirely preventable with the right planning. Let us now talk about who is most at risk of falling into this trap, because it is not random. There are specific characteristics and situations that put certain retirees in much greater danger of triggering an IRMAA surcharge through capital gains. The first group is retirees with large taxable brokerage accounts that have appreciated significantly. If you have been a long-term investor in a taxable account and you have held positions for 10, 15, or 20 years, you likely have substantial unrealized gains sitting in that account. The longer you have held the investments and the better they have performed, the larger those embedded gains are. Every dollar of those unrealized gains is a potential IRMAA trigger waiting to be activated the moment you sell. Many retirees do not think about their unrealized gains in terms of IRMAA risk because the connection between capital gains and Medicare premiums is not intuitive. But if you have a brokerage account with significant unrealized appreciation, you need to be thinking about how any planned sales will interact with your IRMAA situation before you execute those trades. The second group at high risk is retirees who are already close to an IRMAA threshold from their regular income sources. If your Social Security and RMDs already put you at $80,000 of modified adjusted gross income as a single filer, you are only $5,000 away from the first IRMAA threshold. A relatively small capital gain could push you over. Many retirees in this situation do not realize how close to the edge they are because they are not tracking their IRMAA situation against their income in real time. They have a general sense that their income is at a certain level, but they have not done the precise calculation of their modified adjusted gross income, including all sources. The third group is retirees who do portfolio rebalancing without considering IRMAA implications. Rebalancing is generally good investment practice. When your asset allocation drifts from your target due to market movements, selling some of what has grown and buying more of what has lagged brings you back to your intended risk level. But if the assets you are selling are in a taxable account with significant unrealized gains, that rebalancing triggers capital gains income. Doing a large rebalancing in a single year without considering the IRMAA impact can push income well above a threshold when a more gradual or tax-strategically timed rebalancing would have stayed below it. The fourth group is retirees who inherit investments and then sell them. When you inherit stocks or other investments, you generally receive what is called a stepped-up cost basis. This means your basis is set to the fair market value of the investment on the date of the original owner's death, rather than what that person originally paid. This is actually a significant tax benefit because it eliminates the unrealized gain that existed before the date of death. However, any appreciation that occurs after you inherit the investment and before you sell it does create a taxable gain. And in some inheritance situations, particularly if the inherited assets have continued to appreciate and you sell them in a year when your other income is already high, the gain can push you into IRMAA territory. Now let us get into the strategies that can help you manage capital gains in retirement to minimize or avoid IRMAA surcharges. because this is the actionable part that can make a real difference in your financial outcomes. The first and most powerful strategy is income and capital gain, harvesting with IRMAA brackets in mind. This means deliberately managing how much capital gain income you realize in any given year, keeping your total modified adjusted gross income below the IRMAA thresholds whenever possible. Instead of selling a large position all in one year and realizing a large gain, you spread the sales over multiple years, realizing a smaller amount of gain each year and keeping your total income within the standard premium range. This requires knowing your current income from all sources each year, understanding where you stand relative to the IRMAA thresholds, and making deliberate decisions about the timing and size of investment sales accordingly. It takes more planning and attention than simply selling when you feel like it, but the savings in Medicare premiums can be substantial. For example, if Robert and Patricia from our earlier example had spread that $90,000 capital gain across 3 years by selling $30,000 of appreciated stock per year, instead of all at once, their modified adjusted gross income in each of those years would have been approximately $105,200. That keeps them below the $170,000 married filing, jointly IRMAA threshold in each year, and they pay standard Medicare premiums throughout. The investment outcome is essentially the same. The Medicare cost savings are significant. The only difference is planning and timing. The second strategy is tax loss harvesting to offset capital gains. If you have positions in your taxable account that are currently worth less than what you paid for them, selling those positions generates a capital loss. Capital losses can be used to offset capital gains dollar for dollar. If you have a $100,000 gain from selling appreciated stock and you also sell positions with $50,000 in losses, your net capital gain for tax purposes is only $50,000. This reduces both your income tax and your modified adjusted gross income for IRMAA purposes. Tax loss harvesting is most effective when done proactively and regularly, rather than as a one-time emergency measure. But even if you are not currently doing it systematically, looking for loss positions to harvest before you realize a large gain can meaningfully reduce the IRMAA impact. The third strategy is to prioritize selling assets inside tax-advantaged accounts rather than taxable accounts when possible. Sales inside a traditional IRA or 401k do not trigger capital gains taxes because the money in those accounts is already going to be taxed as ordinary income when you withdraw it. Sales inside a Roth IRA trigger no taxes at all on qualified distributions. So if you need to rebalance your overall investment portfolio, consider doing the selling inside your IRA or Roth IRA rather than in your taxable brokerage account. The rebalancing achieves the same investment objective without generating taxable capital gains income that could trigger IRMAA surcharges. The fourth strategy is gifting appreciated securities rather than selling them. If you are charitably inclined and you are planning to make charitable donations anyway, consider donating appreciated stock directly to a charity rather than selling the stock, paying capital gains taxes, and donating the cash proceeds. When you donate appreciated securities directly to a qualified charity, you get a charitable deduction for the full fair market value of the donation and you pay 0 capital gains taxes on the appreciation. The charity receives the full value and pays no tax, either because charities are tax exempt. This strategy eliminates the capital gain entirely rather than just deferring it. and it reduces your modified adjusted gross income compared to a sale and donate approach. If you want to give to multiple charities or spread donations over time, donor-advised funds are an excellent vehicle for this strategy. You contribute appreciated securities to the donor-advised fund in 1 year, take the full charitable deduction, eliminate the capital gain, and then recommend grants from the fund to your chosen charities over multiple years. This approach can provide significant flexibility in both your charitable giving and your income management. The fifth strategy is to use qualified opportunity zone investments for very large gains, though this is a more complex strategy that requires careful evaluation with a tax professional. Qualified opportunity zones are designated economically distressed communities where the federal government provides tax incentives for investment. If you realize a large capital gain and reinvest that gain into a qualified opportunity zone fund within 180 days, you can defer the original gain and potentially reduce it if you hold the investment long enough. This strategy is not appropriate for everyone, and the investments themselves carry real risk. But for retirees with very large capital gains, it may be worth understanding as part of a broader tax strategy conversation. The sixth strategy involves planning specifically around the 2-year IRMAA look-back window. Because your 2026 Medicare premiums are based on your 2024 income, if you know that 2025 or 2026 is going to be a year of high medical expenses or other large costs, you want to make sure you are managing your 2023 or 2024 income carefully to avoid triggering IRMAA surcharges in those future years. Conversely, if you know that a particular year will have unusually high income due to a planned large transaction, you might want to do some proactive Roth conversions or income-generating moves in years when you have income to spare and are still below the thresholds, rather than waiting and compressing everything into a year when you are already at risk of crossing a threshold. I also want to mention the IRMAA appeals process, because it is relevant in situations where a one-time capital gain has triggered a surcharge that does not reflect your normal income level. If your income in a particular year was unusually high due to a one-time event and your income has since returned to a lower level, you can file a Form SSA 44 with the Social Security Administration to request that Medicare use a more recent year's income to determine your premium. The qualifying life-changing events include things like retirement, reduced work hours, divorce, and the death of a spouse. A one-time investment gain alone typically does not qualify as a life-changing event for this purpose. But if the high-income year also involved another qualifying life change, it may be worth exploring. This is another area where working with a Medicare specialist or a financial advisor who understands both tax and Medicare planning can pay significant dividends. One broader point I want to make before we close is that the capital gains IRMAA trap is really a symptom of a larger issue, which is that retirement financial planning requires integrating multiple systems that were not designed with each other in mind. The tax code, the Medicare premium structure, the Social Security income calculations, the retirement account withdrawal rules, they all interact with each other in ways that create unintended consequences for retirees who are only looking at one piece at a time. The retiree who works with a tax professional on their income taxes but never discusses Medicare implications. The retiree who works with a financial advisor on their investments but never discusses the tax impact of their trades. The retiree who talks to Medicare about their premiums but does not understand how their investment decisions affect those premiums 2 years later. Each of these retirees has professional help in one area but a blind spot in another, and the blind spots are where the expensive surprises live. The solution is not necessarily to become an expert in all of these areas yourself, though understanding the basics, which this video hopefully helps with, is genuinely valuable. The solution is to make sure that whoever is helping you with your finances is looking at your situation holistically, connecting the dots between your investment decisions, your tax situation, and your Medicare costs. If you are working with a financial advisor who only talks to you about investment returns and never mentions IRMAA, or a tax preparer who files your return but never discusses how your planned sales for next year will affect your Medicare 2 years from now, you may have a gap in your advisory team that is costing you real money. Now, I want to hear from you. Have you ever been surprised by an IRMAA surcharge that you did not see coming? Did you know that selling stocks in a taxable account could trigger higher Medicare premiums through the 2-year look-back? Leave a comment below and tell me honestly whether this was something on your radar or something that caught you off guard. Your response matters to me, and it helps other viewers in the community understand that they are not alone if they have been navigating this without fully understanding it. If this video gave you clarity on something that was previously confusing or unknown, please share it. Send it to a friend who is retired and has a brokerage account with appreciated positions. Share it with a sibling who is approaching retirement and doing investment planning. Post it to a retirement-focused group or community where people are making these decisions right now without knowing about the IRMAA trap. Sharing this video could genuinely save someone thousands of dollars in unnecessary Medicare premiums, and that is a real and meaningful impact. And if you are not yet subscribed to Jason Retires, today is the day to change that. Every week, we cover the real, practical, often overlooked aspects of retirement finance in America with the level of depth and honesty you deserve. Subscribe, hit the bell, and stay connected, because the conversation we are having on this channel is one that every American retiree needs to be part of. Thank you for watching all the way to the end. It means everything to me that you take this content seriously, because your financial security in retirement is something worth taking seriously. I will see you in the next one.